We're 3 years into the current bull market, and frankly, stock prices are sky high. Now, that's not something that I usually say, but this time it's hard not to. Investors are pricing in a future of strong earnings, steady growth, and basically a near perfect soft landing that lasts for years. But here's the problem. I think we're pushing euphoric expectations at this point. And when that happens, even a small disappointment can send markets tumbling, and a bigger disruption, even just a fear of one, could easily knock stocks down 20% or more. So today I want to show you a smarter way to think about investing when markets feel expensive. And most importantly, how you can build a portfolio that can survive any economic environment. Now, this isn't about predicting crashes, and it's definitely not about timing the market. It's about positioning your portfolio strategically, knowing that a high growth, low inflation environment isn't the only one that markets experience. So let's get into it. First, I want to take a look at the Shiller price to earnings ratio. Now, this metric compares stock prices to earnings, but it adjusts earnings for inflation. And right now, we're more expensive than we've been at any time since the late 1990s. Now, before we go into panic mode, we have to recognize that we can't use Shiller PE to precisely time market downturns. Markets can continue at very high valuations for years. It continued in the 90s for about a year and a half near this level. But historically, this ratio does tell us two important things. Number one, long-term average returns over the next decade are likely to be below average if we fully ride through the bear markets. Number two, when the bear market finally hits, it's likely to be a deep one, especially if PE ratios continue near this level. Now, that's not guaranteed, it's just statistically likely, and investing is all about understanding probabilities. We might coast another year or two like we did in the 90s, or the downturn could begin within 6 months. But either way, the real question is this: is the potential upside worth the potential downside at these prices? For me personally, the full likelihood of upside just isn't worth the full likelihood of downside at these prices. Now, you and I can't predict the next bear market perfectly. No one can predict tops and bottoms of markets, and usually they can't even get close. And it costs investors in the long run to try to do that. But what we can do is prepare for it without jumping in and out of the market, without panicking, and without guessing exactly what happens next. And one of the most effective ways to prepare is by designing a portfolio built for multiple economic environments, not just the good times. This is where regime-based investing comes in. This idea comes from recent research by two individuals from the World Bank. I'll put their name in the captions. I don't want to mispronounce them. Their research gives us a powerful clue of how we might position a portfolio for the long run, thinking in terms of multiple ways that this market could go. So what is a regime? The economy doesn't sit in one steady state forever. We all know that. It moves through regimes. Economic weather patterns, so to speak, that affect asset performance. There are four main regimes you need to keep in mind. Number one, Goldilocks. This is high growth and low inflation. That's pretty much where we are right now. This represents the good times. The economy is expanding, inflation is pretty tame, stocks thrive, and bonds generally do well. Most assets post positive returns in environments like this, and we tend to spend about 70 to 75% of history in this regime. It's the most common by far. Number two, overheating. That's when there's high growth and high inflation. The economy still grows, inflation begins to spike, commodities and gold generally outperform, and traditional bonds often struggle. Three, stagflation. Low growth, high inflation. Now, this is the nightmare scenario for most investors, and it's the regime that most traditional portfolios are least prepared for. This is when growth slows, inflation rises. Tips, gold, and commodities often shine during this time, and stocks and traditional bonds generally suffer. And the final one is the downturn. This is low growth and low inflation. We see recession or contraction and rates fall. Government bonds generally rank among the best performers during this time, and stocks often decline. So each of these regimes rewards different assets. But here's the problem. Most investors build portfolios only for the Goldilocks scenario. So when the winds change, they're exposed. But what these researchers suggested is that there appears to be a better approach. You build a portfolio that works across all regimes, an all-weather portfolio. So what are regime-based portfolios? Well, in their research, the authors built 4 regime portfolios, each one optimized for a specific environment. And here's what they found. Downturns favor mostly government bonds. Stagflation often favors tips and gold. Overheating generally favors gold, commodities, and REITs, which are real estate investment trusts. And Goldilocks favors a more diversified mix, including stocks. These are very different portfolios because the regimes themselves are very different. And here's the interesting part. The magic doesn't come from choosing one or picking the right one. It comes from combining them. The researchers mixed the regime portfolios using 4 methods, but I'll mention the one that stood out. I'll call it the equal risk contribution across regimes portfolio. Now that's a mouthful. Think of it like you're preparing for the weather. You don't assume that it's going to rain 25% of the time this year, but you make sure you're not completely unprepared for rain. The equal risk contribution across regimes does the same thing for markets. It gives each type of economic weather an equal share of your portfolio's risk so that no single storm can wipe you out. And they compared this portfolio against standard models of traditional asset allocation like the 60-40 blend, 60% stock, 40% bonds, the risk parity portfolio, or what's called the traditional mean variance optimization portfolio. So which one won? This is where things get really interesting. In the full 50-year sample, the equal risk contribution across regimes portfolio was the most consistent performer, especially in downturns and stagflation. It also had the lowest drawdowns. So in plain English, that means it was the hardest portfolio to break. But the real surprise came in the out of sample test, because the traditionally optimal portfolio that academics typically think of, it's called mean variance optimization, it fell to last place when measured by the Sharpe ratio, which is just a way of comparing how much return you're getting for the amount of risk that you're taking. So the traditional portfolio underperformed pretty dramatically. The equal risk contribution across regimes portfolio had the lowest maximum drawdown, the best Kalmar ratio, a strong Sharpe ratio, and the best results in every major crisis: 1987, 1998, 2008, 2020. In other words, the portfolio that didn't try to guess the next regime performed best when the markets misbehaved. To say it another way, a portfolio built for all weather has fewer weak spots. Now, how do you apply this? There's a lot that we've covered here. You don't need a PhD, and you don't need a complex econometric model to apply this in your portfolio. Here's how everyday investors could use it. First, look to own assets that win in different regimes. Each regime has its champions. In Goldilocks, it's stocks and REITs. In downturns, it's often government bonds. Stagflation, we're looking at tips and gold. Overheating is commodities, gold, and real assets. Even small allocations to each of these helps. 2, don't let one regime dominate your risk. Many portfolios are 80 to 95% equity risk, meaning nearly all Goldilocks. It's assuming a Goldilocks environment. A more balanced risk footprint might be something like 45 to 60% equities, 10 to 20% treasuries, 5 to 10% corporate bonds, 5 to 10% REITs, 5 to 10% tips, treasury inflation protected securities, 7 to 12% in gold, and maybe 3 to 6% in broad commodities. None of these numbers are meant to be precise. It isn't financial or investment advice. This is education, and it's certainly not a one-size-fits-all strategy, but it reveals one way that this might be applied practically in real life. Third, use simple, low-cost ETFs. You don't need complexity. ETFs can allow you to gain passive, diversified, low-cost exposure to multiple assets without having to choose individual securities yourself. Categories matter more than the tickers themselves. And 4, just make sure to rebalance once in a while. At least once a year. This prevents any regime exposure from dominating the portfolio or getting out of your target allocation. You're not timing the market, you're maintaining alignment with your long-term goals. And discipline beats prediction. So in summary, yes, markets are high right now. They're very high. But consider that sometimes the best returns do come near the end of a bull market. Jumping totally out of the market could cost serious upside if things continue in a positive direction. Being all in or all out and jumping in between those over time gives up significant compounding returns on average. So it's important to recognize that we can't predict the next recession. We can't predict inflation spikes. We can't predict geopolitical shocks with perfection. We can build a portfolio designed to survive all of them. You don't need to predict the future when your portfolio is already prepared for it. So regime-based investing gives us a powerful insight. There is no single best portfolio because there's multiple regimes that markets go through. There are only portfolios that are prepared or unprepared for the real world. And by diversifying with regimes in mind, you strengthen your defenses and create a smoother path to long-term wealth. It creates, in essence, a type of all-weather portfolio. If this perspective resonated with you, I'd love to invite you to join the founding member waitlist for the Wealth Expedition, my soon-coming membership platform for everyday wealth builders. And inside, you'll find community, accountability, guidance from myself. I'm a CFA charter holder with over 13 years of real-world experience working with clients around the world. You'll find story-driven maps and practical lessons and tools. Now, only the first 100 people will receive founding member status. But I'd love to have you on the journey. I'll put the link in the description. And of course, if you found this helpful, please subscribe, like the video, and make sure you don't miss an episode. Until next week, this is Daniel Lancaster, signing off.